in the paper, Impact of Financial Inclusion on Default Risk of Social Responsible Firms with cross-country evidence. So, Dr. Bolaji, please, the floor is yours. As usual, we will have 1 hour, and feel free to ask questions. Okay, thank you very much.
Thank you very much for the opportunity to present the paper. Also, thank you for those who are present. Thank you for your time. So the key titles in the world are Impact of Financial Inclusion, Default Risk, Socially Responsible Firms, Cross-Country Evidence. So what is financial inclusion? Financial inclusion has been defined in various ways, but to summarize all the definitions, financial inclusion is continuous improvement in the quality, quantity, and efficiency of financial intermediary services. What is default risk? Default risk is the likelihood that a firm will experience default, especially at a higher debt ratio. So what is socially responsible firms? Socially responsible firms are firms that engage in corporate social responsibilities to the society. What is cross-country evidence? Cross-country evidence here means that the sample cut across Latin America, Asia, Africa, and some part of Middle East. And the purpose is to enrich the robustness of the conclusions. To summarize the major findings, the paper is actually centered on 2 objectives: to investigate the impact of financial inclusion on debt of socially responsible firms, and also to examine the impact of financial inclusion on the default risk of socially responsible firms in developing and emerging countries. The key findings from the research is that financial inclusion significantly increased the debt of socially responsible firms in the full sample of 15 countries. Then it's also consistent across 3 regional subsamples. Conversely, financial inclusion significantly reduces the default risk of socially responsible firms in the full sample, as well as the 3 regional subsamples. The 3 regional subsamples are included to increase the robustness of the findings across regions. What if the result is significant in the full sample or differs in the region? Then we can have more implications from the regional perspective. The key implication of the finding is that deepening financial inclusion can increase socially responsible firms' access to credit at a reduced cost, and also financial inclusion initiatives that increase socially responsible firms' access to bank credit at reduced cost can reduce default risk. The motivation. So firms' global corporate default has been on the rise, and this rise in global default up across United States, developed countries, including emerging markets. So this shows that default risk is not only a problem limited to the emerging market, it also applies to the developed world. Now, financial distress has implications at the micro level as well as at the macro level. When a firm experiences default, it affects the business as a going concern. It affects the employees of the firms. It also affects their families due to the loss of jobs. And not only that, it also contributes to declining productivity because aggregate of the output at the micro level makes up the output at the macro level. So default risk is an important area of study. Initially, default risk used to be inferred from debt, meaning that higher debt ratio signals default risk. But debt is just one ratio. There are other factors that can also trigger default risk. So that is why the objective of the study captures the traditional measurement of default risk, which is debt, and the combined Z-score, to actually capture the default risk. So the debt held by firms as a share of GDP has increased greatly in developing and emerging economies, according to Statista 2024. Over the same period, corporate debt as a share of GDP in developed economy has also increased. And interestingly, this trend is even more observed in developing and emerging economies. The graph shows that China experienced default. You can see the debt ratio is actually very high compared to other selected countries. So an indication that debt ratio in China is significantly higher. It is even twice the value for the United States.
Sorry, what do you mean that it indicates default?
No, higher debt ratio is an indication that firms will likely experience default. When the debt ratio is high, it's an indication that default risk is likely to occur. I'll explain it in the theoretical framework for that. Financial inclusion is recognized by policymakers and banks as an important development area to ease access to finance. Most empirical literature has concentrated on financial development in terms of quantity of credit given to the private sector, but less attention is given to financial inclusion. For example, access to finance. Although the number of adults without access to an account has steadily increased over the years, it has also declined, but the value is still substantially large. Across the region, countries in Latin America, Sub-Saharan Africa, Middle East, and Asia, they are lagging their European counterparts in getting access to finance. So indicating that financial inclusion is an important area of focus in this region. Unlike previous studies in the literature, our paper investigates how financial inclusion impacts the debt ratio of socially responsible firms in developing and emerging countries. Secondly, our paper focused on the impact of financial inclusion on default risk of socially responsible firms. Although there are growing empirical and theoretical research focusing on how CSR impacts firm debt maturity, they overlook how financial inclusion can impact default risk, especially for CSR firms. So additionally, our paper covers 3 regions to improve the robustness of our conclusions. Now the theoretical framework. Now, the area that looks like rectangle captures firms without debt financing, meaning equity financing. So equity financing is less risky compared to debt financing. Now, if you look at the line, the straight line, it captures linearity. So meaning that as debt ratio increases, the value of firms increases. Now, this linear relationship was proposed by Modigliani and Miller. But Modigliani and Miller make an unrealistic assumption. The assumption is that there is no financial distress risk. In the word of Miller, if there is no financial distress risk, what happens is that firms can use as much debt as possible. So the value for the levered firm will be higher than the value for the unlevered firm. But in reality, this is not true. So the trade-off theory argues that there should be an optimal debt ratio that maximizes the value of the firm. But there's a problem in the literature. The problem is that the optimal debt ratio is unobservable. So how do we capture this optimal debt ratio? So what researchers have done over the years is to express the optimal debt ratio by pegging it to the industry ratio. Other researchers argue that the optimal debt ratio is not static, that it could change. So Other researchers, they introduced rolling optimal debt ratio. Rolling optimal debt ratio does not capture other factors that impact the debt ratio itself. So after over 60 years of research, the optimal debt ratio has been expressed as a function of microeconomic factors as well as macroeconomic factors. Now, this optimal debt ratio, because it is not static, it calls for dynamic modeling. So this will be explained in the methodology section. So you can see from this graph, the firm will not always be at the optimal. Optimal debt ratio last year, they might deviate from it. They might need to adjust back to their previous debt level to avoid default. So there is dynamism captured in this theoretical framework. Now, the theoretical framework for the first objective, financial inclusion is expected to increase debt for simple reason that socially responsible firms that prioritize the need of stockholders, they enjoy lower cost of debt financing. So all else constant, financial inclusion makes access to formal financial services easy at a reduced cost and can increase bank deposit base, which in turn enables financially responsible firms more access to bank credit. Therefore, we hypothesize that holding other factors constant, financial inclusion will increase the debt of socially responsible firms. Tying it back to the theoretical framework, meaning that it's an additional factors that can push the optimal debt ratio upward a bit.
I have a question. Just a clarifying question. Can you tell us exactly how you measure financial inclusion? And also, it seems that you are assuming that financial inclusion comes with low borrowing costs. But that is not necessarily true because interest rates, we know that will depend on many factors. So what do you mean by
So yes, so that is why in coming up with the hypothesis, there is all else constant. So all else constant here means that you hold other factors constant. So that is why that statement is there. So if other factors are held constant, then we are focusing on the financial inclusion. Of course, if you relax the assumption of all else constant, other things comes into play.
But why you say that this at low borrowing cost? That is something that we observe in the data, no? Or
yes, because the sample size that we have, they are CSR firms. So the CSR firms, because they engage in CSR activities, they are perceived as they have enjoyed good reputation in the eyes of lenders. So this enables them to access debt financing at a reduced cost. Yeah. Right. So that is why. So the sample size is restricted to CSR firms.
Okay.
Thank you.
So we do observe that that across CRS firms and not CRS firms, the CRS firms have lower interest rates.
Correct.
Okay. All right. But this is because of sample selection or is because of what?
Not necessarily. Yeah, it could be sample selection. Since our focus is on CSR firms, then there's no point including non-CSR firms. Because our focus is on the CSR firms. Thank you very much for that question. For the second aspect of the objective, we are looking at how financial inclusion relates to default risk. And our expectation is that financial inclusion will decrease default risk. So banks' financial inclusion strategy enables them to reach wider customers at reduced cost and attract more deposits, which in turn can be channeled to socially responsible firms, according to the Mekong. Besides, socially responsible firms, they build reputation over time, which enables them to obtain bank credit at a reduced cost, which in turn lower their default rate. So holding other factors constant, socially responsible firms can raise the needed debt financing at reduced cost to fund profitable investment that decrease their default risk. So we also hypothesize that holding other factors constant, financial inclusion will decrease default risk of socially responsible firms in developing and emerging countries. Now, come to the literature. So a lot has been done in the literature. But what we can highlight is that financial inclusion allows unbanked people to be integrated into formal financial services. Eventually, the outcome will improve economic activities, and it also ensures that resources are transferred from the surplus to the deficit unit. Banks play important intermediation function, according to Peter. Actually, Peter actually hinted on the importance of financial inclusion, but he didn't call it financial inclusion. He called it access to finance. So from the insight from Peter, the concept of incorporating financial inclusion into the model actually come into play. He hinted on it, but he didn't capture it in the modeling framework. The main theory that we are using is the trade-off theory. There are other theories, but because the trade-off theory specifically hinted on default risk, as shown in the theoretical framework in the previous slide, at the optimal debt ratio, it equates the benefit and the cost of debt financing. Debt above the optimal debt ratio indicate default. The stakeholder theory claims that socially responsible firms participate in corporate social responsibility activities who reduce unsystematic risk. And default risk is an example of unsystematic risk. Socially responsible firms, they build reputation over time because of their corporate social activities to the society, and they may have easy access to debt financing. According to Chen, the finding revealed that CSR seems to reduce corporate default risk, especially during period of economic uncertainty. During economic uncertainty, the risk of default is high, but because of this good gesture of the firms, they can still get some access to financing at reduced cost. Moreover, findings indicate that banks, branches, and automatic teller machine have big impacts on growth, actually it's economic growth. According to Tang and Chan, digital financial inclusions, which is captured by the degree of digitalization, reduce the cost of debt financing. Unlike these previous researchers, we do it differently. We incorporate financial inclusion directly as a function of the optimal debt ratio indicated in the theoretical framework. Secondly, we also look at the impact of financial inclusion on default risk. Now, the default risk is a composite Z-score, which is more informative than just using the debt ratio. And it was developed by Altman, which will be explained in subsequent slides. Additionally, our paper focused on regions. Why regions? Because if we look at the full sample, what happens if we split the sample into regions, the result might be different. If the result is different, then we can draw regional differences to explain the difference in the result. And if they are the same, then it means the results are consistent. So the regional division of the data help us to improve the robustness of the conclusions. Okay, in terms of the data, like I said, the data are CSR frames. And this sample period covers 2012 to 2019. There's a reason for this. To isolate the impact of the pandemic crisis, because the pandemic crisis have a sharp impact on firms during those periods. So that is why it was excluded. The data starts from 2012 to also exclude the impact of the 2008 crisis. It was 2008 to 2009, but the impact of the crisis in US was delayed. It gets to developing countries 2-3 years afterwards. So to remove the impact of this crisis, that was why the data starts from 2012 to 2019. Someone can say, why not include dummy variable? Yes, dummy variable can capture the shock of the crisis, but some have also argued it does not accurately filter the entire impact of the shocks, especially the COVID-19 shocks. It was so huge. when we look at the graphical display of the data. Our data also captures macro and microeconomic variables. And the main variable of interest is financial inclusion. It's actually a macro variable. Not only that, we also focus on 15 developing and emerging countries. Okay, I'll explain later on how the composition comes about in the next slide.
Sorry, this is annual data?
No, time series data. It's time
No,
series.
but what is the frequency?
2000 and
But annual data?
Annual data,
Okay.
yes. Annual data, yeah. Annual data. All right, so our main variable of interest is bank branches per 100,000 adults and ATM. They actually capture access to financing. And our dependent variable is actually default risk, which is captured by the Z-score. So I need to explain something here. The Z-score, the higher the Z-score, the less likelihood of default. The lower the Z-score, the high likelihood of default. So that is how the Z-score is computed. Because this Z-score, it has implication for the regression later on. That's why I'm highlighting this. Other things to highlight here is that you can see that the Z-score is a combination of liquidity ratio, profitability ratios, and also we have working capital ratio. So it's composite compared to just using a leverage ratio, which is a traditional way of inferring default. In the macro, they have a benchmark of 65. Above 65, then they will tell you to do something to reduce your debt ratio. But at the micro level, there's something like a guideline to follow. So the industry is what they normally use to track the optimal debt ratio, as I explained in the previous slide. Now, initially, it was supposed to be developing country, but after some time, I realized that developing country, they have now become emerging market economy. According to the IMF report, they classified virtually 13 out of this sample into emerging market category. So emerging market means that they are ahead of the developing countries. They are not close to developed countries, so they are in between. But they have potential to become developed countries. And most of this emerging market economy, they also have, they are middle income category, actually. They are not so high, but they are in the middle. So when I look at the sample size, only Kuwait and Qatar falls under developing country, according to the IMF classifications. And the reason why they put Kuwait as developing country is because of population dimension is small. And if you look at the criteria for coming up with the emerging market, because population is small, so it tinted Kuwait back into the developing category. And this is the model specifications. Now, the model here is dynamic. Now, what makes the model dynamic is the addition of the lag dependent variables. So what it means is that previous year debt and previous year default will affect the current year default. Now, prior to this, we also did some prior regressions to show that the fixed effect model is preferred. But the fixed effect model is a static model. From the theoretical framework, there is dynamism into it. So the theoretical framework already hinted us that dynamic model should be used. So even though the fixed effect is supported, fixed effect is a static model. It doesn't capture dynamism. So that is why we specify dynamic model, and previous researchers also specify dynamic modeling. So later on, we'll be watching out for the coefficient of the lag dependent variable. If it is significant, it means the model is truly dynamic. If not, then we can as well use the fixed effect. And the main variable of interest here is financial inclusion. It's our main variable of interest, which captures access to finance. So we employ the two-step system GMN. So why the two-step? The one-step system GMN has been used also, but the two-step uses optimal weighing matrix. In other words, it ensures that the coefficient estimated is close to the true value. Not only that, previous year default or debt could also affect current default. Therefore, dynamic modeling is more appropriate and it is consistent with the dynamic version of the trade-off theory. So I don't want to disturb you so much with this. This is just to tell you what happens in the estimation. The GM estimation started with a single model. Then we take the false difference. The false differencing of the model remove the unobserved firm specific. Why? Because when you take changes, the constant disappears. So equation 2 becomes equation 1. Now, equation 3 now, even though we have solved the problem of unobserved firm specific effect, we introduce another problem. The problem is that changes in y, it minus 1, will be correlated with changes in uit minus 1, contemporaneous correlation. So to overcome this problem, we rely on internal instrument. So the internal instrument automatically comes up when you run the system GML model. But this is what happens in the software. Now, the validity of the system GML and the difference GML depends on the moment condition. And this moment condition requires that the correlation between the changes in the error term and the lag dependent variable should be equal to 0. And also, the changes in the error term and the lag independent variable used as instrument equals to 0. Now, internal instrument is more efficient compared to external instrument. When you use external instrument, if the external instrument is not reliable, you create more problem. So that is why the system GML, the difference GML, uses internal instrument via higher order lag of the dependent and independent variables to resolve endogeneity problem. Now, the correlation result, basically, we are interested in multicollinearity here. So multicollinearity becomes a serious problem when we have value close to 0.8, although some say 0.7, but roughly between 0.7 and 0.9, it shows that some variables have to be dropped in the model. We also used VRF, the variance inflation factor. It also shows that in the model, the VRF is less than 2, so indicating that multicollinearity is not a problem. This is the preliminary stage to running a regression estimation. Now, this is the result. The coefficient of the lag-dependent variable, they are all significant, indicating that the model is indeed dynamic. ATM and bank branches, proxy for financial inclusions, positively related to debt ratio, indicating that the financial inclusion actually increased debt ratio. And the validity of the GMM model requires that the Einstein's test should be satisfied. So the Einstein test also indicates that the model is correctly specified. And also the ART test of autocorrelation also indicated that there is absence of autocorrelation. So the model is can be thought of to be reliable. So debt and financial inclusion, we also use the difference GMA. From the estimation, you can see that the development of this GMA starts with the difference, then the system. So we also use the difference GMA to check the robustness of the conclusions, and the results are still consistent. You can see from the lag-dependent variables, it shows that the model is indeed dynamic because it is significant. And both financial inclusion and bank branches, as proofs for financial inclusion, they are also positively related to debt ratio. Now, coming to the default risk, like I explained earlier on, the default risk proxy is actually a Z-score. So higher Z-score means that there is less default. So lower Z-score means there is likelihood for default. So you can see that the coefficient for the ATM and the bank branches actually positive. Increased Z-score meaning that it lowers default risk. This has to be highlighted because I've seen some papers where they interpret it wrongly because they overlook how the Z-score is measured. And also, the post-estimation test, which is the Einstein test, as well as the ART test, they are also satisfied, indicating that the model is indeed dynamic.
I have a question again. Are you controlling for any measure of sovereign default risk?
Okay. In these model specifications, we choose variables based on theory. Now, in the default risk model specification, how the theory has developed over the years, they didn't focus so much on macro. It is only recently they now begin to see that, oh, not only micro can cause default, macro can also cause default. So that is why my research is trying to introduce macro dimension to it. So that's why we control for interest rate. We also control for financial inclusion. So like what you said now, yeah, for financial inclusion. So moving forward, since we have been able to prove that financial inclusion and interest rate impact default risk, it also means that there are other macro variables that can also come in to affect default risk.
So interest rate is the monetary policy interest rate for each country?
Yes, for each country. All right, thank you for the question. So similarly, we also use the difference TMM to improve the robustness of the conclusion. And we also run the result for different regions. And the results are consistent across regions, indicating that financial inclusion indeed lowers default risk. Now to wrap up, to conclude, in the full sample, we have shown that financial inclusion increased debt, but it reduced the default risk for socially responsible firms. Moreover, financial inclusion increased debt, but reduced default risk of socially responsible firms for the 3 regional subsamples. So this result supports our argument that holding all factors constant, bank financial inclusion strategy enables them to reach wider customers at reduced cost and attract more deposits, which in turn can be channeled to socially responsible firms. Consequently, they can actually raise their debt finance at reduced costs to finance profitable investment that lower default risk. So the findings has implications for managers, it has implications for policymakers, it has implications for investors. For managers, socially responsible firms may have easier access to debt finance to fund business expansion. Businesses always look for money to fund their operations. Engaging in CSR activities can be one of the keys to attracting this funding. Firm managers, financial inclusion initiative that increase firm access to bank credit at reduced cost can actually decrease default risk. And for policymakers, they should continue to encourage banks to deepen their financial inclusion efforts and provide financial services that can increase firms' access to financing. While for the investors, when they want to invest their money, they should consider firms that engage in CSR activities, because over time, it has a way of increasing their access to finance, which in turn can be used to finance profitable investment that lower default risk. This research has limitations. The limitation of this research is that the financial inclusion proxy captures access to finance because the focus of the research is on access to finance. Remember I said that Schumpeter hinted on access to finance, but he didn't bring it into modeling. So the gap that we are trying to capture in the literature is avoiding access. Other proxies of financial inclusion, such as usage, for example, outstanding deposits and loans, it actually indicate usage, and mobile money transactions actually indicate there is a usage. We can also look at penetration dimension of financial inclusion, which is deposit and money account, an indication that there is penetration. So this can enrich the robustness of the findings. Although effort was made to use this dimension, when I look through the data is not yearly. I could see that 2014, 2017, 2021. So how do you smooth it out? Although there are ways to do that, but I don't want to involve in data, so I don't want to go into that. So maybe later on, if data become available, I can incorporate and broaden the proxy for the financial inclusion. Aside that, the study also do not explicitly focus on the link between financial inclusion and real investment. Now, one of the things that lowers default risk, using debt financing is not bad. But what are you using the debt financing to do? So if you use, even if you get the debt financing at a lower cost, if you use the debt financing to finance unprofitable investment, it will still create default risk. So this is implicit in our implication, but we do not directly look at how financial inclusion link to investment. So future research can also explore how financial inclusion are linked with investment. So this will show more light and also improve the robustness of future findings. So welcome for any question. Thank you very much.
Thank you very much. It was a very interesting paper. I have a bunch of questions, but let me open the floor. We have like 15 minutes, so please, is there any question?
I have one question.
Please.
I know just about financial inclusion. I see just two indicators about ATM and the bank branches, but it's all about numbers. How about the geographical features? Just like 1 kilometers, just the numbers of ATM or branches, does this also work?
I think I've seen some measurement of financial inclusion go in that dimension. Or when I flip through all the data, sometimes you'll find that the data is missing 3, 4, 5 times.
Oh, yeah.
It becomes difficult to incorporate that. So these two indicators are the ones that have data continuously.
Yeah.
So that's why I used it. But that also has also been used in some developed countries, in particular, that have continuous data.
Yeah. I see just in the developed country and the new emergency market, actually, this kind of geographical features, you could also find it from bank focus, especially about these two, just like numbers of these two, and also something like online users. Maybe it's also for just for work for the poor people.
Yeah. Thank you for your exposure. Yeah.
Any other question? Yeah.
Yeah, you mentioned that you hypothesize on other variables constant, and you find the impact of financial influence. How you means take the other variables constant? Like you didn't find the impact of other variables, you just find the impact of one variable.
Okay. What it means is that usually let me to answer that question. I will use an example of a common demand equation. Price affects quantity, but we know in reality there are other factors that also affect quantity. So most economists, what they do, because they know that the world is complex, so what they usually do is that they hold some factors constant. It doesn't mean that they cannot be explored, but for the purpose of the research they are doing, they hold some factors constant, so they focus on the variable of interest. So increase in price, demand declines. But we know that the price of other commodity can also affect demand. So I use that analogy to let you know that in economics, holding other factors constant is a valid way of proposing the hypothesis you are proposing. So there's nothing wrong in doing that. However, you are also right that other factors, if you can identify them, to be good, that we incorporate in future research. But for this research, it has to be done within a time frame. So that is why we have to impose that restriction. But like what you said, we also control for other factors like interest rate. Now, interest rate is an important macroeconomic factor because when interest rate goes up, it triggers default. When the World Bank gives money or any bank gives money, if the interest rate is going up, they will not repay back. It will lead to default unless you are making enough profit to repay back the loan. That is why debt financing itself, okay. The problem initially was that those that develop the default risk model, they are mostly accountants and finance people. So they think in the black box, micro. But because my background is micro and macro, I'm trying to open up the box. There are other macro factors that can come in. So I incorporated interest rate. But you are also right. Other factors can come. They also make a comment that there are other conditions that will come in, which is true.
Yeah, according to my understanding, as you mentioned last one, service means that prices are affecting the demand. So in your case, you are saying that to differentiate, or we can say that to differentiate between micro and macro, you just hypothesize that macro variables are affected, or like micro variables in setting models, right?
Yeah. Both micro and macro are included.
Okay. And one more thing, you used a word robustness. How do you check the robustness? Through which estimation?
Okay, now, the robustness that I used is the difference GMA. Originally, I used the system GMA. Now, there's a reason for that. The system GMA actually is a system of equation, meaning that it uses the level equation and the difference equation. So what happened is that it uses more information. And in econometrics, when you use more information, you improve the estimate of the parameter. So compared to the difference GMA, the system GMA has been proven to be more efficient. However, because the difference GMA leads to the system GMA, so they are together. So the logical robustness check will put the difference GMA because the difference GMA is also designed for a dynamic model. And my model is dynamic. Bringing in fixed, full random effect is not applicable here because they are static modeling. And from my theoretical framework, I already proven it that the debt ratio is not always optimal. It can deviate in the previous year, it can adjust. So there is dynamism. So dynamic model fits it. That's why it is used.
Translation I also be sorry to everyone. Could we go other robustness checks as well, like quantile threshold?
Okay, quantile and threshold can also be used, but here in this study, I'm not trying to capture linearity, non-linearity, so I'm capturing actually linearity. So if the study is capturing non-linearity, then that will come into play. But it's a good suggestion. Thank you very much.
Any other question? Then I think I will jump in. Thanks again. I really find the finding very puzzling because, I mean, observing at the same time higher levels of debt and lower default risk is puzzling, right? Because usually you expect that as you accumulate more debt, the probability of default is higher, right? So what is the mechanism that you have in mind that you think can reconcile these two facts? Like how CRS companies can have access to more debt and actually face lower default risk. Do you have any mechanism in mind?
Now, the whole idea is that the CSR itself provides the mechanism. Because when firms engage in CSR activities, why are they doing that? Even though it contradicts their initial objective of profit maximization, but when they engage in CSR activities, what happens is that they are looking at long-term horizon. So over the long term, it enables them to enjoy loyalty from customers, and it also enables them to enjoy debt financing from banks. Because nowadays, banks now try to be more generous to firms that engage in CSR activities. Now, because of this, obtaining debt financing at reduced cost is an advantage to CSR firms. So as they get access to debt financing and they use the debt financing to finance profitable investment, it tends to decrease the default risk.
Okay, very interesting. I mean, it's similar to all this literature on corporate green bonds, no, and the greenwashing and all this. Okay, yeah. So perfect. Any other question? Okay, so if there is no any other question, let's stop here. Thank you very much. And please, there is coffee outside, so we can keep the discussion going. Thank you very much.
Thank you very much.